There's a simple mistake that new traders make that's getting them stopped out way more than they should, and today I'm going to show you exactly what that is. We'll talk about why I don't like the popular saying of cut your losses early and let your profits ride. I'll also show you a deep Gartley pattern that is on my radar with an incredible risk reward. Plus a winning Cypher that shows you why rules-based target adjustments, keyword rules-based, do matter and can benefit your trading. And a lot more other valuable lessons as well. All right, let's hop in. I've got a Gartley pattern. Now, you've got to check this leg. I missed the 786 by 1 pip. Now, if I missed the 786 by 1 pip, is it a Gartley or a butterfly? And yes, I had to actually use my magnet to anchor these on to make sure they were 100% correct. I had to bring up my little deal right here and measure it right 213.50 to make sure I didn't get there to high 213.49, right? But Akil, it's so close to the 786. Well, I don't have a so close rule. For me, it's black and white, black or white. Yeah, I guess black and white would be gray. That'd be bad, right? It's black or white. It's either one or the other. Either it hit or it didn't hit. Now, one of the issues with trading and Forex specifically is because there's no central data feed. Often we get different quotes on these setups, right? If you went from one data provider to another, my chart may be slightly different. You see it more of Aussie pairs for some reason. That is a question that I still don't know the answer to. And I've spoken to Australian brokers. I'm like, hey, what's up with your data? Is it because Australia's upside down and backwards? They said, no, maybe. But they don't even have a reason for it. Australia's not upside down and backwards. Everything's just poisonous there. But more so than not on those Aussie pairs. But one, trade what you see. This is why I would recommend using a consistent data feed, right? Two, if you want to use I don't know if you want to call it common sense, if you're like, yeah, Keel, I know, but it's right there. You can create a rule for close enough. Did you guys know that? If you think this is close enough, and you're like, no way, this is a Gartley because it's right there, 1 pip I know, right? Make a rule that says if price action comes within X pips of said area, then it counts as the area, round up. You get what I'm saying? You can make a rule. If price action comes within 5 pips of 786, then I count it as a 786. You can do that. And guess what? Is it still rules based, guys? Is there any gray area there? No, it's still rules based. Yeah. So this is going to be an extremely deep Gartley. It is going to complete at the very highs right below my X leg, which someone mentioned is going to give me an incredible risk reward. Let me get this into the pro trade log real quick, and then I want to talk about a question I got from Costas, I believe it was. I just looked at it, but my memory is so shot. But X to A, A to B, B to C, C to D. Let me just get this in real quick. Here we go. Hey, Coach, I'm watching today's live room. I have a quick question. The D completion of the Cypher is at the 786. No, that's a different question. Okay, it wasn't Costas. Who asked me so many questions? Ryan. Okay, there we go. Hey, Akil. On yesterday's live stream, you talked about a Cypher pattern on the euro dollar. You mentioned when price goes above the X point, the Cypher is considered invalid. This would be for any pattern. Once it's aside from any pattern that completes within the X. Once it goes beyond the X point, the Cypher is considered invalid. So does that mean that you use the X point as your stop loss for the pattern, right? So let me ask you guys this. Why, yes, if price moves beyond the X point, I consider the pattern to be invalid. But why would it not be a great idea to put my stop loss there? Why do you think? It's a good question. And I've got a better answer. Why would it be a bad idea to place my stop loss? right at 1 pip above the X, because that's technically where it's invalid. Because it's structure, yeah, but if it's we can do the same thing for a structure trade. If that's the point that makes it invalid, doesn't Akil always say you want to cut your losses short within reason? Meaning as soon as your setup is invalid, you should look to be out of the trade? Well, let's go to some structure-based trades. Let me ask you this. When price comes down to a structure level, let's take this structure level right here. Does it always reverse exactly at the structure level, or does it sometimes go past, right? If we were to look at this level of structure right here, right? Would you call this a hold or a violation of structure? If you were looking for some type of pullback trade that came right to this level of structure and you're looking to buy it up right here, would you consider this candle a hold or a violation of structure? Well, it's a clear hold, right? Price did not break and close below, right? A clear hold of structure. But guess what? If your stop loss was right below this level, would you be in or out of the trade? You'd be out of the trade. So the truth is this, right? We want to know what our violation points are. We want to be out of a trade as soon as, or we want to be out of a trade once price tells us that we're more likely to be wrong than right. But we also need to give the market breathing room. And the market knows that a lot of new traders do this thing where they say, well, if price breaks that level, then we should be wrong. So I'm going to get my stop loss 2 pips, 3 pips, 5 pips below that level. I don't know if you guys have ever done that. I did that at the beginning of my trading career because I was so literal about this level being important. And the market knows that. So what do you think the market does? It goes down there and gets your stop loss. Bigger traders, smart money, right? Institutional traders, they know where those stop losses are at, guys. They know where the sheep, they know where the sheep are hiding their orders at. And they will push it down there to get them. Yeah, right? So you got to give the market breathing room. Even going off the conversation we had earlier about different data quotes and stuff like that, right? Your low may be a different low for someone else. So yeah, you want to take these levels into account, but you also want to give it enough breathing room so that you can absorb any silly wiki action, right? Because you see this all the time, right? Again, this whole level is a hold of structure. But look at this, right? We have a structure right here. We kind of spike down, but then we hold above, right? Same thing. It happens all the time. So that's one of the differences between like the newbie traders that are doing dumb stuff. And again, it's unconscious incompetence. They're not doing dumb stuff purposely. They just don't know. But they don't give themselves enough breathing room. And what we see is that they actually end up making the right call when they make the right prediction. Just price gets them out of the game before they have a chance to benefit off of it. And that's one of the worst feelings in the world. So there's a difference between knowing the violation point. And the violation point is more for like, hey, once this point is violated, if I wasn't in the trade already, I shouldn't be in it. But there's a difference between knowing that and then the place that you actually put your stop loss, right? That's why I use ATR stops, right? The ATR is a volatility measure. It provides me that buffer zone of saying that, hey, I understand that price action could get to this level and it could dance around a little bit, but it shouldn't move more than blank ATR beyond this level. If it does, then yeah, we're not always wrong still. It can still move wherever and come back, but I know I'm more likely to be wrong than right. So I thought it was a really good question, and I hope that answer provides you some clarity. But that is one of the biggest mistakes I see with newer traders. It's funny because they do that. And it's because of that dumb saying. Again, it's the saying of, what is it? Cut your losses short and let your winners ride, which the general concept makes sense. I spoke about this in the Trading Coach podcast episode the other day. But the idea is that, like, hey, make the most out of your winners and don't take big losses. And the general idea is like, hey, don't move your stop losses back when you know you're wrong, and hey, don't take your targets early when you're right. Make what you're supposed to make out of your wins, and don't give back more than you're supposed to give back from your losses. That's the general idea. But I think when we hear it, especially in a sense where we're not very educated, we think like, okay, when it's winning, I'm just going to hold on to it forever and get out at the very top. And then what happens is the market retraces and we end up actually making less money than we would have made if we had a set target. Or with stop losses, it's like, hey, oh my gosh, price went 1 pip against me. Let me get out right away. Yeah, I'm cutting my losses. When the reality is like we need to give the market time to breathe. I saw this in investing a lot too, where, you know, some of my investment partners, where we'd be in a deal and like, and again, investing is more long term. So we're thinking like, hey, I'm looking for this to play out over the next 6 months. And we enter an investment and like, it's down the first week and they're like panicking, like, oh my gosh, it went against us. We're in the red. I'm like, dude, like this is a 6-month play. Like we don't even expect the news that we think is going to happen to affect the market for like another month or so. We're just positioning ourselves early. Like, why are you freaking out? Like it's gone a little bit against us. It's nowhere near our danger zone, but that's the human element of it. So I think it's the saying is legit, but I think the interpretation is sometimes wrong. So, all right, real quick before we give you guys a break because we need to do it. Unless you guys want to go straight through. Do you guys just want to bang straight through? Someone shot in a pattern. I need to go back. I forgot who it was. Yusuf said, hey, Akil, would you say that an X to A leg, would you say that's an X to A leg for you? Took an hourly bat on the pound yen. All right. And you shot a chart in. Let me just see that real quick. Hourly bat on the pound yen. Here, where's your chart? Would you say this is an X to A leg for you? Okay. Time to play the game, ingrain this picture into your mind. Because we're going to play the game of pattern or no pattern, or rather, yeah, we'll say pattern or no pattern. And I don't have one loaded up because, nope, that's not it. Sorry, that's structure or no structure. Give me a second here. Bam. All right. Voting is ended. We've got results. We've got the majority of people saying no. Now, again, don't let this take away from necessarily your opinion, but unless something is blatantly wrong, then as long as you're identifying things consistently, that's all that matters. For me, it would be a no. There's two things. One, I don't see this as an X to A. I would see, if anything, this would be an X to A. I see this as an individual move, and I see, I see this as an individual move, not the greatest, but I would break this move up into two areas, like that. Yes, Cypher as well, from, was this yesterday's Cypher? I forgot when we looked at it, yeah. But also, again, and this goes off kind of a conversation we had before, just visually, right? If I were to measure this out, visually, what doesn't stand out for me is that this B right here is not the highest retracement. We had this weird situation with, what was it, Aussie, I think it was Aussie dollar a while ago, but this B is clearly not higher than this retracement right here, so, or even the further one. So this visually doesn't stand out as a kind of a clear W type move for me. So for me it would be a no. Yeah, it would be a no for me. For you guys, same, was it the X to A for you guys as well? For you guys that said no? Now again, if you are consistently seeing moves like this, then that's fine. But just make sure all of your moves are going to be like that. And that's the key with pattern trading, is like, unless something is blatantly wrong, like a core principle is wrong, as long as you're seeing things consistently, then your testing results will be consistent based on what you're seeing. And if you're seeing things and maybe something that's considered a different way, but your testing results are good, Well, that's all that matters, is that your testing results are good. So if you see it differently than someone else, but you're still getting the good results, all that matters is the results at the end of the day. So there we go. I always said valid Cypher for show, but as a back pattern, I would not see that X to A. Here's our Cypher, as I like to call him. Let's use this tool. Here's our zone of completion for the Cypher. And if you would to measure your, this is a good example too. I got a question about this. If you're to measure your targets, I got a question about targets the other day, and or actually yesterday too. And it was, do you measure targets from the C leg or the A leg? And it does depend on the pattern, right? But think about, you want to measure your targets from that deepest level. So for the Cypher, it's going to be the C. For a bat or a Gartley or a butterfly, it would be the A, because remember that A is deeper in those patterns. So you would take your Fibonacci retracement from swing low to swing high right here. But here's the cool thing, right? We always have this debate about rolling targets or not, right? So initially, you're looking at a target. Let me just delete some of this stuff, guys. Hold on. Initially, you're looking at a target right here, right? This was your initial TGT1, right at that 382. You can see that we did not get anywhere near it relative. However, I don't want to say what we should do, but what we teach as far as advanced pattern formations is to roll your fibs with price action. Because at the end of the day, and from a philosophical standpoint, I have no problem with you keeping them where they are. It makes life a lot easier when you're actually trading. But from a philosophical perspective, if I keep my Fibonacci right here, what is the point of my Fibonacci? Who can answer that? What is my Fibonacci actually measuring anything? Like, what is this a 382 retracement of? If I keep my Fibonacci stagnant, does it actually measure anything, or is it just random? It's just random, right? So that's always been my reason for dragging it. I would actually prefer structure-based targets for patterns, because I use structure for everything else, but it just doesn't work out that way. So there has to be a reasoning behind everything I do. So that's why I like dragging it, because as I drag it, now it is back to being the Fibonacci retracement from this low to this new high. And you can see in this case specifically, we came down. If you drag those targets, you would have hit those targets. Came the structure as well, which is interesting. Always interesting how structure plays a role. If you didn't drag it, you would still be waiting. So I'm always a fan of dragging it. So as price action makes its way up, boop, 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 boop. Drag your targets to those new highs. And as price action makes its way back down, hopefully you get triggered. Hope you enjoyed the vid. Today's footage comes from our live trading room. If you ever want to join us in the live trading room, myself in the New York live room, Jason in the London live room, check us out, www.tier1trading.com. It is part of your 14-day risk-free trial membership. So sign up, get on the platform, jump in the live room, talk to the community, take some courses, and enjoy 14 days of trading education.